All right, welcome back to the show, folks. The show's called Your Money or Wealth. We're helping you out your overall financial planning journey if you're 20s, if you're 30s, 40s, or 50s. Some different steps you want to make sure, different milestones that you want to hit as well. Before we get into the 50s, let's see how you did on your true-false question.
Retirement account contribution limits are the same for every age. True or false? Well, that is false. We just talked about when you're in your 40s, a lot of times you get a little bit behind. You got the kids, you got college funds, you got a home payment, all kinds of things come up, right? Sometimes in your 50s, you got to catch up a little bit. So hence the IRS gave us some catch-up provisions. IRA, $7,000 is the amount you can make per person, but if you're 50 and older, you can add another $1,000, so that's $8,000. 401k, $23,000 currently, but if you're over 50, you can add another $7,500. $30,500 would be the amount you can save annually in that 401k.
This is a lot of times people's peak earning years, and so they might have a little bit more discretionary income, so they give us some catch-up to put it in the plan. Let's talk about what the savings should look like here. So we've accumulated that $480,000. Things are looking good. I'm 50 years old. Now I'm making $130,000 a year. All right, 130. What do I need? 8 times. So when you're in your 50s, you need 8 times that annual salary. So now I'm going to try to make it to that $1 million. I got to double my money here over that 10-year period. What do I need to do? Well, you need to save $1,100. Not too bad, because the larger the base here, that 6% compounding, you can see money grow on money a little bit faster. And so the savings rate goes down a little bit to still accomplish my goal.
Yeah, and that's an interesting example, because in reality, in many cases, people end up saving a little bit less in their 40s because of all the other responsibilities. They have to save a little bit more in their 50s to catch up. Whichever category you're in doesn't really matter. The point is you're trying to get to that goal into your 60s where you have enough capital, enough investments to be able to retire.
What strategy should you do, Al?
Well, I think one way to do this, particularly if you're a little bit behind, is you're generally, as you're getting older, usually you're making a little bit more, usually you're a little bit more valuable to the company. You may get more raises, you may get more bonuses. Pay very close attention to them. As you're getting raises, make sure that you allocate some of that raise into your savings, right? So, you know, you didn't have it before, so now you keep some of it, but more goes into savings. Bonuses, same way. Maybe keep half your bonus and you save the other half, or whatever makes sense for you. And that way, Joe, you can start catching up with when you're behind.
Yeah, saving, bonuses and raises. We talked about tax planning. Here's what happens a lot of times is that, all right, I'm just saving money. I got to save 10%, 20%, 12% of my overall income. I'm putting everything into the overall 401k, and then that's compounding nice. I hit this good dollar figure, but guess what? Now everything's in a pre-tax account. It's like, man, I should have been a little bit more tax savvy. So does it make sense to start moving the dollars around from a tax perspective to have more control over your taxes in retirement? If you believe tax rates are going up in the future, I highly suggest you think about moving money from a pre-tax account into a Roth account. You do pay the taxes on that conversion, but if you think you're going to be in the same tax bracket or maybe a higher tax bracket, or start doing some calculations to give you a little bit more flexibility and freedom in retirement as you start drawing the income, I think this makes sense for a lot of people. And then we just talked about the catch-up contributions.
Yeah. And that's really important for people in their 50s and sometimes when they're 60s. So Joe, sometimes you get into your 60s and, well, I'm still behind, right? So now I got to start getting a little bit more serious here. Save more, spend less. It's kind of obvious, but it becomes important, right? You may need to keep working longer. You may need to work part-time in retirement. You may need to delay Social Security so that it's a higher dollar amount. There's all kinds of stuff you can do to make your situation better.
All right, let's switch gears here. Let's start answering some of our viewers' questions.
This is from Julie in Oceanside. I'm 34 and thinking of taking a loan from my 401k to put a down payment on my first home. How does that work? Julie, great question. You're in California. I know it's very tempting. California prices are very high. We would tell you not to do it. There's better ways to try to figure out how to get a down payment. So please don't do it. That's for your retirement. But if you simply must, here's how it works. You can take a loan out of your 401k for up to $50,000 or half of your 401k balance, whichever is lower. That's number one. If you pull money out of your 401k, you got to pay tax and you got to pay penalty. It's interesting that with IRAs, you can take $10,000 out of an IRA. You still pay tax, but no penalty. You do not have that same rule, Joe, for a 401k.
Yeah, I don't know, Al. I think I disagree. If you want to buy your first home, she's in her 20s or 30s. She's got some money saved up and you want to take a loan. Basically, you can take a loan tax-free and you're just paying yourself back with interest. So if that's the only way that you can get capital, I'd much rather have her take a loan out than maybe a distribution and pay taxes and penalties.
All right, this is from Tom. Are short-term bonds better to have than long-term in retirement? Long-term bonds are more subject to interest rate risk in terms of going up and down, but they pay a little bit more generally.
I think in today's interest rate environment, people are looking for yield. And so if you have a short-term bond, right, you're going to take very little risk, but you're going to get very little yield. And so I think as people approach retirement, they're looking for income. And a good way to do that is through a coupon, through a bond. And if you hold that bond to maturity, as long as there's not a default, you will receive your coupon payment and you'll receive 100% of the bond back. But I agree, there's a lot more risk in long-term bonds. A lot of things can happen. So you want to be careful. But if you want yield, longer-term bonds are going to give you more income than short-term bonds. So if you want to have a safer portfolio, you want a laddered bond portfolio that would give you the income that you need, that could be an option. I don't know if there's better or worse. I think they're just different, and it really depends on your overall situation.
Yeah, and I'll say one more thing. In terms of longer-term bonds, I would be more inclined to purchase a longer-term bond when interest rates are higher than lower. So just think about that.
All right. Financial planning at every age. You got to have a savings goal. You got to figure out how much money that you want to save per month, per year to get to certain targets. Financial strategies. What are the strategies that you want to utilize each and every year to make sure that you're on track? And then you're covering your bases in regards to risk management, insurance, cash, buying a home, different goals, and then making up for lost times. There's a lot of different levers that you can pull. Life gets in the way all the time. So you just want to be consistent in your overall strategy. Write it down, review it, update it, and then just keep kind of plugging away. Go to our website, yourmoneyyourwealth.com. Click on that special offer this week. It's our retirement readiness guide. Are you ready for retirement? Well, we can get you ready. Yourmoneyyourwealth.com. Click on the special offer. That's our gift to you. And that's it for us. For Big Al Clopine, I'm Joe Anderson, and we'll see you next time, folks.